I think there are some things the Fed could have done to help the real economy better, and we can talk about those. But just to the extent households and small businesses have to rely on banks as credit, that's primarily your transmission mechanism, and you can't force them to lend. And especially when big banks can make a lot more money without credit risk by doing, underwriting, trading, et cetera, their incentives to do small business loans in particular are reduced unless it's guaranteed, as we saw with the PPP program. They've shown very little interest in the Main Street lending program. So again, you have to rely on small banks, and they've been stressed. So yes, JPL is right. The tools are not elegant. The traditional tools are really not well equipped to help here. But, so I think there's almost a moral imperative. I know he's been criticized for getting political and urging fiscal relief. I also think there's a moral imperative here, though, for the Fed too, because the income and wealth inequality impact of the current interventions, because it has really propped up the corporate sector, propped up equity markets, which overwhelmingly benefits the very wealthiest in this country. It is almost a moral imperative for the Fed to press as well for fiscal help for Main Street, which we're not getting right now.
So how does the Fed then do more here? In your opinion, what else should they be doing?
Well, I think, so on their corporate debt interventions, I think they could have focused more on primary debt issuance, be more surgically focused on primary debt issuance. I thought they've never intervened in corporate debt markets before. This is huge. But when they did it, they kind of broadly intervened in the secondary market, which helped investors. But really the point was to help corporations as employers who needed access to the public debt markets to continue to fund themselves. Really no focus. So they set it up, they haven't used it on primary debt issuance. And then by just providing this broad, backstop to the secondary market, there really were no strings attached. So you've seen a lot of the beneficiaries directly and indirectly of Fed interventions and with the corporate debt markets. They're still doing buybacks. They're still doing dividends. They're pursuing M&A. It's hard to see that much of that money is flowing into job creation or job preservation. So I think they could have been more targeted and surgical on their corporate debt interventions. In terms of household help, I've really advocated for getting much more serious about central bank digital currency and giving households and maybe small businesses too the ability to access directly or indirectly reserve accounts, so that when you need to increase money supply in a distressed situation like this, give it directly to the sectors that are stressed. Right now, again, we're transmitting it through banks primarily and into loans, and there's a lot of debt out there already. So households in particular, and small businesses right now, they really need cash. They do really need more loans. So exploring this new technology to see if that's realistic to do that. Obviously, it needs to be authorized by Congress. It does arguably fuzzy lines between fiscal and monetary, which is why there should be tight controls around it, and it needs to be authorized by Congress. But I just wish the Fed would get more serious at looking at technology, because I think it could be a good automatic stabilizer to pump money directly into the sectors that need it when we get into a situation like this.